Today, I invite you to be a part of the discussion that addresses an intersectional niche existing between someone's money and its meaning, which applies both in a literal and philosophical sense. For those who have listened to episodes previous will know that this is not a financial podcast. However, today it's a very mild version of one. And perhaps it's the most it'll ever be. Personal finance is shedding its vanilla reputation for one that's really becoming more and more personalized to an individual's lifestyle and ideals. Helping us navigate through this is today's guest, Dave OLeary, and someone who I think really stands out in this particular area of impact investing. For some time now, people have unfittingly qualified green types of investment as being part of the responsible movement or the catalyst to large inflows of investor contributions, aka money that comprises people's retirement incomes. The reality is that there are so many more themes that fit inside this categorization than simply environmental initiatives. This topic is one that I'm very active in learning more about, sometimes from Dave himself and other times by my own accord. I try my best to avoid having any brains take the shape of pretzels, but I know that this is a set of ideals and a method of investing that's brand new to a lot of the public. It might also be shocking to some to know that this is even an area that a significant majority of financial advisors have little to no idea of when asked about it by their own clients and prospective clients alike. So please take your time in listening to this episode and make use of the rewind button if needed, because this is a topic that can have a profound impact on the environmental, social, and governance futures of the world as we know it. So I have the pleasure of being joined today by someone who has probably the coolest headshot I've seen in a long time on a company's website. He's a financial planner, holds an MBA from the University of Toronto, and chartered financial analyst. For those who maybe are a little bit unfamiliar with the alphabet soup of financial designations, it's a pretty big deal. He's a former competitive boxer and has contributed to, well, pretty much every financial media outlet available in Canada, a person who I would like to default to as being the de facto expert in impact investing and one of the few experts in responsible investing, or RI, in Canada. He's a much better podcaster than I am myself and host of a much more popular show, the Impact Investing Podcast. All of this in addition to being the founder of Kind Wealth. I'm encouraged to be joined here by fellow impact entrepreneur, Dave OLeary. Dave, welcome to the pod.
Hey, Tim, thanks so much. That is a very flattering introduction. And thank you. It's hard to hear, but I'll take it.
For sure. Well, it's about all the words I know anyway. I think you and I are on the same page when it comes to a lot of things financially related, but I don't want to put words in your mouth here. So in my mind, I think it's fair to say that to varying degrees, we as Canadians live hypocritically, myself especially at times. As a former base trader, can you speak to your journey and the personal revelations that you experienced, which led you to pursue, I guess, a path that's very atypical after not only realizing your authentic self, but ultimately helping other people align their wealth with their personal values?
Yeah, I'll try to give you a short version of this story. I started my career, which was a big part of shaping who I am as a person beyond just who I am in my business life, I guess, with an organization called Morningstar. And Morningstar is a provider of investment data and research and consulting services. They do a whole bunch of different things. But I worked in a group where we did investment manager research. And so what that means is we would provide analysis of professional money managers, so the people running pension funds or mutual funds. And we would write these very long form, detailed research reports that would say whether a particular, either a mutual fund or the manager in the team running that particular strategy or mandate was doing a good job or not on behalf of the investors who they were investing for, and whether we thought they would be able to outperform the markets, beat their benchmark over the long term. And Morningstar's whole mission was to really help investors make better decisions, and in particular to stick up for the little guy, the investor who doesn't have a big portfolio, doesn't know a lot about their investments, but would like to go somewhere they can get an objective opinion about whether their money is being well taken care of. And that stuck with me. I mean, they were very militant and strict about maintaining their objectivity, and crafting their business in ways that didn't compromise that objectivity. And as an analyst there, I got to lead a team of 7 or 8 analysts, and we were often commenting on the companies that would that we would be, our sales department would then be selling software products to, or data to, or our investment research to. And not once were we ever pressured or made to feel like we needed to change an opinion that we offered. And sometimes we were quite critical. So I've digressed on that part of the story just because it's such an important part of, I cut my teeth in the industry there. I spent 13 years there. And so that it was ingrained in me. I met my wife in 2010 after about 9 years into working at Morningstar. And that she came from a humanitarian world that led me on a whirlwind of adventure, where I took a sabbatical from Morningstar, spent a couple months volunteering in Sierra Leone. We ultimately moved to South Africa, spent 4 years living in South Africa, traveling a lot of sub-Saharan Africa, visiting community projects, which we were supporting with a bit of money we had. And that ultimately just led me on a course of like wanting to do more positive things. But I'll just cap this story with, spending more of my time and energy doing things that had a positive impact. But the ultimately culminated in, I wanted to use my background in investments and this expertise I had already built to make a positive impact. And that ultimately led me into responsible investing, impact investing, and setting up Kind Wealth. And my experiences with Morningstar was that I saw a lot of the underbelly in the industry, a lot of the ways in which the industry is set up not to the benefit of the end client, the end investor, the end consumer, but to the institutions that run the financial services institutions. And I got tired of critiquing it in the media and from the outside, and wanted to do something about it. So Kind Wealth was all right, let's stop just complaining about the problem. Let's do something about it. And so that's where it's led me.
Right. And I think that, I guess, at least at some point, the undertones here is that finance at times can probably be a language, or at least considered a language in and of itself. And with that, I think it's fair to say that, well, that what we are about to talk about is probably a topic that a lot of people, and I would maybe even go so far as to suggest that even the most seasoned financial advisors are included in this, aren't very savvy with responsible investing, just in the broad sense, at least yet. It might be best to start as broad as we probably constructively can be, and then focus the conversation from there. So with that said, can you please give the listeners maybe a broad overview as to what responsible investing and impact investing are, and then further to that, like maybe what differentiates each?
Yeah, it's a great question, and it's so important that we stop and define our terms, because often what's happening in this space is that people are using these terms to mean different things. And I'll caveat all of this to say that there are still, one of the problems we have in this industry, it's relatively new, and I'm going to stress the relatively. I mean, there's been folks doing ESG and responsible investing for hundreds of years, and arguably where we started was a lot more responsible than where we are right now. But the formally like impact investing as an industry is maybe a decade old, a little more. Mm-hmm. And so the terms are being used in different ways. I would describe it as this. Responsible investing is kind of the overarching term that I use for anywhere where you're going to make investment decisions, where you're consciously thinking about the impact that it has, or the ways in which it aligns with your values. And that can look like a lot of different things. So within that responsible investing bucket, I would say there's terms ESG, socially responsible investing, and impact investing. And you could probably think of some other terms, but those are maybe the biggest ones.
Mhm.
ESG investing is maybe the most similar to traditional investing, and even ESG investing can look like a few different things, but we'll just say it, I think the way it's most commonly practiced, and the way where, and this is where this part of the responsible investing industry is the biggest. It's attracted the most assets. It's got the most momentum. You're seeing folks like Larry Fink at BlackRock and a lot of these other very large investment managers jumping on this train quickly. And what they're doing is saying, what we need to be factoring in when we decide which investments to make through our funds is whether the companies that we are doing our due diligence on are what is the environmental what impact are they having on the environment? What are the environmental risks and social risks and governance risks to our investment? So an environmental one would be, what are their waste management practices, for instance? Well, if they are careless about their waste management and they're regularly, contravening waste management laws, they potentially are putting themselves, they're damaging the environment, but what the ESG investor at its core really cares about is this a risk to me and my investment? And it could be if they potentially face a lawsuit, for instance, or if they're treating employees poorly and they could face a lawsuit, or they just don't retain employees because they don't treat them well. As a business, as an investor, I care because I don't want my investment to lose value. So what they are doing is saying, we've been doing all this due diligence on companies, and we've been ignoring these factors, which probably we should have been considering all along in our due diligence, and we hadn't been. We've been considering these things externalities. We didn't know how to incorporate it in. And I think what they've been convinced of is that it's worth bringing these things into the investment decision because they should improve your research, your due diligence process so that you achieve a better risk adjusted return. So I'll maybe pause there for a second because I've been rambling a lot before the other explanations will be faster, but that gives an idea of like what ESG is investing at its core. I don't think it doesn't have to be done. I guess the point I would stress is it doesn't have to be done for the purpose of making the world a better place or because you have some sort of moral imperative that you have to see expressed in your portfolio. It's most often being done because they see the financial case for it.
Yeah, absolutely. And I think that, well, see, this is such I think, a different point of intersection, at least in my mind, because I have a traditional, I think, outlook, or at least classically traditional outlook on how investments should be managed. And then now it's contravening that, to which I think that the investment industry as a whole is kind of moving into a different kind of direction, at least in some senses of that. And just listening to you kind of explain that, I'm brought to a memory that I kind of had in college when, at least at that point, there was a big, or at least a large influx in the organic food movement, and how it was becoming largely commercialized, at least in the United States at that time. And there was one farm in particular, and I don't want to name it for a myriad of reasons,
Sure.
but they literally misled their audience as being like labeled as organic. And to me, it's the classic bait and switch, if you will. In the RI space, this is essentially the foundation, I think, of a point of contention with those wanting better corporate practices, for example, and entities finding a way to unjustly fit into this segment, let's say, of ESGs. And I'd love to get your thoughts on greenwashing, I guess, as this coined, and the implications of this happening as more people look to RI options.
Yeah. So the investment managers who are incorporating at its minimum ESG, where they say, I don't care at all about, and by the way, some ESG investors do care about the positive impact of these things, but you can do ESG at a minimum for only the purpose of improving your risk adjusted return. And there's different ways to go about applying it and putting that into practice. So I think the most common form that I've seen of greenwashing would be it's a kind of insidious. It's hard to pinpoint and label. So for instance, what you'd have is an investment manager who says, here's our process for how we go about investing in stocks. And every manager worth their salt will have a very clearly defined way of going about putting together an investment portfolio, all the way from the research, any screening process they do, to the research they do, to the portfolio construction, selection, managing, and monitoring of that over time. And every manager's got a different approach. I mean, there's common ways of doing it, but they each have their own, and it's a big part of, managers will talk about it being a big part of their success. And that process has historically ignored some of these environmental and social factors. Oftentimes they've actually been pretty strong on the governance side, because they've always sort of seen that governance actually impacts their bottom line as an investor. But these E and these S ones, they've incorporated some of them in the past. I mean, different managers to varying degrees. And so what they're doing is saying, oh yeah, we've been doing this ESG stuff. We're ESG investors. Like, look, there are some E factors we've been considering and some S factors, not many. And what they're doing is saying, yeah, so we're ESG. We've integrated ESG into our process, but it's very, very, very light. And so, and listen, that would be fine if you said, we're not factoring these things in because we're going to make the world a better place. We're just factoring in what we feel like is important to us producing a better return. Then that would be fine. But then they turn around and will market it very heavily as, look at us, we're saving the world, and we've got these wonderful, amazing portfolios. And that, it's just not their intent. They haven't really changed much. They've been doing what they've been doing all along, and their portfolios, if you look at them, don't look incredibly clean. But most people don't look into the fund and then see what investments it's making and what underlying investments it has. They'll just see that ESG is in the name, or socially responsible is in the name, and buy it. And so that's sort of like, you can see how they're not lying about it, but it's really kind of playing up the marketing and overselling something that hasn't really changed. They haven't really done much to change what they've been doing all along. The other way that it happens is, indexes. So a lot of it's passive investing. So you take a basic index and then you screen out the bad. These are called negative screens, and you screen out the bad actors. And you can create a bunch of screens that sound good, but at the end of the day, when you put it into place, it doesn't actually change much of what you're really investing in. And so again, unless you open up the hood and look at the investments, you don't really notice. You just hear, oh, well, we don't invest in this, and this. But if you look at the fine details, it may be, just as an example, like, oh, well, we don't invest in companies that operate for-profit prisons. Well, you look at the details, like, well, if 50% of their revenue or greater comes from for-profit prisons, then we won't invest in them. But if it's 40%, that's fine. We'll include it. Like, but all you see at the headline is, we exclude for-profit prisons.
Mm-hmm.
So it's stuff like that. It's not lying, but it's, I think a lot of people, if they looked at their ESG funds, would be disappointed by what they found in them.
Right. So focusing on the E and the S components, so the environmental and social component here, I want to kind of maybe go into a little, maybe not deviate too far from what we're talking about here, but I think in general, it's no secret that North America kind of lags their European counterparts when it comes to taking, I guess, environmental action. And I don't think that I would be the only one who's curious to know what your thoughts as to how participating in impact and RI might influence the practices of, I guess, corporations, given the momentous challenges that we face on the social and environmental front.
Yeah, I mean, this is a real big topic. There's a lot of conversation going on various fronts. I mean, I think it has the effect of, companies are responding now, and they're responding for a variety of different reasons. It's not just because ESG is being integrated or there's ESG products being created, because there's a lot of confounding variables. So what's also happening at the same time is that people are practicing conscious consumerism at a much greater rate than we ever have historically. And so, these companies are experiencing changing demand for their products and services because of that. They're experiencing changing demand for their, for the stock in the secondary markets and the public markets for that purpose, and that's affecting potentially the stock price. And then they're experiencing shareholder activism to some degrees, right? Where the largest shareholders are now getting a lot more careful and insistent upon engaging with the management of those firms to get them to change their environmental and social practices. And so, you can do ESG without any shareholder activism, right? And shareholder engagement. So there's a whole bunch of factors going on here. But I think what's happening is that there's clearly more and more people are caring about how their wealth is, whether how they spend it or invest it or donate it even. They people care about the impact of that at an increasing degree. And so companies and organizations of all flavors are having to respond to that. So I think that the more that we do this, because there are detractors who will say, listen, this responsible investing stuff isn't actually, and ESG isn't actually going to really move the needle. It's, we can talk about some vanity metrics that it's doing more about making you feel good than it is actually about changing things. But I'd say, listen, the more we get people to think about the impact that their money has, we can debate the whole, how much those specific ESG investments are having an impact. Mm-hmm. But the habit and the practice of thinking about how your money impacts the world is very important. And the more that we do that, the better things will get. And so, and we'll get better and better at, being smarter about how we make a bigger impact, even if the ESG stuff we're doing right now, isn't having a huge impact. And that's an open debate. But I'll give you a very quick analogy. I remember there's a very famous math professor, I can't remember his name, math prof at Wharton. And I remember reading his book, and he talked at the beginning about people, often don't do the math on things and have a hard time keeping numbers in their head. And one of his examples is people will say, oh, I walk up the stairs if they're trying to lose weight. And so they'll say things like, oh, I'm going to take the stairs every day and that'll help. And then he does the math on like the calories that you burn from walking up the stairs versus, and look how silly that is. It's just not moving the needle at all. You might as well not do it. And I think what that misses is like, listen, that habit of walking up the stairs is probably creating some sort of behavioral changes that's having spillover effects into other things, like drinking more water or whatever those things are. Like beyond the actual effect of those calories, there's other, we're complex beings, and they have like that thing isn't happening in isolation, and it's probably leading you to other positive effects. And I think the same is true of people getting into the habit of investing responsibly.
That's a great point. That's a great point. I think that the behavioral aspect of any kind of, I guess, financial action that we take really is the bigger consideration. And that's just from a financial planning standpoint, something that I guess, personally focus on. So I want to ask you a couple of questions about a chart that I saw first from you based on what you presented. And it was the first time I actually measured, I guess, on a 3-dimensional basis, the impact of an investment. So for those who, because we live in charts, I suppose, for those who don't, a 3-dimensional, I guess, assessment on a graph, it measures 3 variables. So in this case, it was your traditional risk, reward, and the impact of the investment. With that, there seems to be a juxtaposition, I think, between, I guess, like how maybe malleable a corporate culture is in North America and further to that, it's revenue generating practices at large. And the investor, I think, is forced to decide between whether they should choose superior returns or superior ideals. So can you just speak just to the oversimplification that I think of claims that exist between green options, simply that they cost more and return less?
Yeah. So let's clarify our terms. If we're saying green in just the loosest sense of anything positive, yes, not just environmentally positive, I think my answer to this question is, if I'm going to just restate the question, mm-hmm, do you have to sacrifice returns to do something positive?
Basically, yes.
And the answer is no, not always. Mm-hmm. And I think that's just, it's one of those things that I was raised in an industry and indoctrinated into Milton Friedman free market capitalism, which is Milton Friedman was an economist who is famous for advising Ronald Reagan and Margaret Thatcher. And his philosophy has dominated capitalism for as long as I've been alive, and probably for the generation before me, that we should be just maximizing profit at all costs and don't worry about the impact of whether you're doing any good. Because once you take those profits, then you can use those profits to do whatever good you want. That's an oversimplification, but that's essentially the argument. And that because you can't, your goal is, if the underlying implication is that if you do something positive, it's costing you something. And we were all just taught that and believed it and bought into it. And it was only, maybe 8-9 years ago myself where I started to, I heard people questioning that and then question it myself and went, well, right, where was it ever written that you necessarily are going to sacrifice return to do something positive? What does that mean? That there are no possible worlds, no possible scenarios where there's a win-win? I mean, on the other hand, I would say there's not always a win-win in every corner of every part of the investment universe. So to say, I think what happens in our circles, in the ESG and responsible and impact investing circles, is we say, oh, look, you never have to sacrifice returns to do something positive. The answer is it depends.
Yeah.
What type of positive impact are you trying to have, and in what way you're trying to have it? If you're trying to, to give you an extreme example, if a disaster hits, it's a hurricane or a flood in a developing country, and people are out of their homes and need medical help and food supplies, and that's the impact you want to have. Oh yeah, it's going to cost you, and you're not, it's going to cost you. There is no investment opportunity. You're actually just going to give money to get supplies and emergency equipment into this. If that's the impact you're trying to have, I expect 100% financial loss because we just need to give that money and those resources. If you're saying to me, can you create a technology that's going to help us solve the climate crisis? And what does that net? Do you like? Is the will you definitely lose sacrifice returns to do that? No, I mean, I can imagine a technological solution that might be outrageously profitable and make you, outrageously rich in the process. So, it depends on, again, what type of impact are you trying to have? So I'll just leave it at that.
Yeah. Okay. So on that, on your own podcast, I mean, you completely talk about the impact that I guess people's dollars can make in a real world scenario, oftentimes. So with that, I'm curious to know, because finance is sometimes intangible. Like, for example, I invest $1 into a fund.
Right.
Realistically, there's no tangible effect that I can create, like I can draw from that until perhaps I sell my investment. So in the impact sense, how do you, I guess, talk about the tangibility factor, maybe, like I'll use air quotes, tangibility factor, in making an impact investment to somebody who maybe is completely unfamiliar with, what actually they're trying to, I guess, like better outcome they're trying to create?
Yeah. So how do people know what type of positive impact they're having?
Yeah. Yeah.
Yeah. So there are, so things like certain parts of the equation are easier to assess and measure than others. So, for instance, measuring the carbon emissions of the companies you invest in is a fairly straightforward process. I mean, I don't want to oversimplify it. There are assumptions being made along the way, but, it's, it lends itself much better to quantifying than a lot of the social improvements that might happen. And so aspects like that, I think you could probably pretty clearly calculate. It's not being done for people very easily, but if you wanted to calculate, hey, I used to have a portfolio that was invested this way. Once I made these changes, I can now measure the kind of differential in the carbon emissions that I'm supporting with my investment dollars. And then you'd have, you could go down a rabbit hole and say, well, just because you're not invested in, you took out your $50,000 investment from those companies didn't change at all the fact that they're emitting those carbon, emissions still. So we could have that discussion and then talk about, but you're contributing to, a trend, which is you with all these other investors who are moving more and more money out of these companies, and consumers who are stopping purchasing from them. What impact has that had? So, there's no direct way to quantify in a way that couldn't be, dug into further and pressed and questioned. But you can kind of go about it from some of those angles. You can take a look at, hey, listen, when you get into the social side, like how well they're treating employees and their supply chain transparency and a whole host of things, it gets harder to quantify. I mean, I don't know. But I think, again, if we're going to insist, like, we're babies at this. Investing has been around for, thousands and thousands of years. And this impact and responsible investing, where we're actually trying to measure these things, has been around for a decade or two. And so, like, people who are insisting that, we'd be better at measuring this stuff immediately, it's like, well, can you give us a minute? Like, can we have a second here? I mean, you've been doing this for thousands of years. We've just started this. We need some time here. So we're going to get better at it.
Yeah.
And parts of it'll never be quantified perfectly. But if your criteria is, well, I need it to be measured perfectly before I'll do it, then, you'd never get started on anything. But I do appreciate the desire that people have to want to feel better about, to know that the changes that they're making are having a difference in the world. And so, like, there are things like, different providers, ratings providers of ESG data. So Morningstar Sustainalytics is one. There's Refinitiv, MSCI has their own. So you could look at the ratings and, generally say whether the investments you have are improving, or getting worse. And, but it doesn't give you, the problem is it's not something tangible, right? You're not going to leave like, oh, I just saved, I don't know, 10 years of somebody's life because they, we've improved the environment and the air quality because of this. Like, you just don't get that type of tangibility, unfortunately.
Yeah. But you allude to a certain, well, I guess an important theme here, in that regardless of if it is industry or from an individual standpoint, that we all need to start somewhere. And with that, I guess the reality is that like, we do need to start somewhere. And if it's something that you're obviously interested in. So as a part of my practice, I've made it, I guess, a point to give clients access to, I suppose, RI options, although it's fairly new and I'm certainly not an expert in this at all. But I do note that it's light green. So can you tell the people listening how they might go about accessing maybe ESG or RI options for themselves who perhaps don't work with an advisor?
Yeah. So, I mean, the easiest way to do it, I mean, everybody's different. Like, what I would say is the improvement that you make is far better than the improvement you intend to make, you'd like to make, and you never actually execute. So I could give you a lot of things you could do that require a lot of time and effort and energy. And if you're just not that inclined or motivated or capable of doing those things, then it's not going to be helpful. So, like, at a minimum, what a lot of people can do is select those kind of prepackaged options, whether it's through a Questrade account, which is like an online trading account you can open yourself, and they'll give you an option where you just answer a questionnaire and put you into a portfolio. You go to an online provider like Wealthsimple or a Nest Wealth. I'm not sure. I think Nest Wealth has an SRI option, but I know Wealthsimple does. And it's like a reasonable option. It's definitely better than a non-SRI socially responsible alternative. And they're super simple to do. Yes, there's going to be stuff in there that you don't like and it isn't great. But again, the change that you make is better than one that you sit around talking about. So those are like the easiest ways if you're not a DIY investor, but you don't have an advisor that's going to give you help. If you are working with an advisor, just even the very fact of asking them the question and saying that this is important to you and you'd like some help, you're not going to get much help. But asking the question is important because it sends the signal to the market that more and more people care about the stuff. And we can always make the argument that, well, what does my one, voice count? Well, you can argue about that at anything. Nobody would, the world would never change if we always took that approach. So, so asking your advisor, setting up an online, either a brokerage account where you could trade yourself or a robo advisor is a way to go about doing that. And the last thing I would say you could do, this wasn't exactly the question, but I'll add it anyway, is if you've got a pension through your work, those pension assets are being invested somewhere, ask about it. Ask whether you have options for socially or environmentally responsible options within your pension. Because, and your HR department's going to look at you like they're not an expert in this. What do they know? But if they get a lot of employees asking more and more about this, they have a pension consultant usually who's helping them figure out their pension plan and what options they provide. They need to hear that message. And most people don't, they think most people will automatically recognize that how they spend their dollars has an impact. Oh, that company treated me garbage. I didn't like the customer service I got. I'm not going to buy from them anymore. Or I just don't like the way that they're handling these issues or their stance on guns or whatever it is. I'm not buying from them. We don't think though, hey, I don't like the way that company's acting. I have exposure to that through my pension plan. I don't want that anymore. Like we need people to do that. So go to your HR department and ask them about whether you have responsible investment options.
That is a great suggestion. Actually, I didn't think about that one before. So yeah, thank you very much for bringing that one up. I guess maybe the general, I guess the consensus of this conversation is that all roads kind of are leading towards pursuing the path of like guided transformation, whether that be again an industry or at an individual level. With this in mind, this is I think maybe a very ambiguous question, but
Sure.
with this in mind, what might the future of impact investing look like to you in the retail space? Might it be reasonable to think that Canadians at large might be able to like economically align their core values with their investment dollars in the not too distant future?
I mean, the time scale is where I'm the least clear. I think we're on an irreversible trend. I don't think there's a world in which 20 years from now, people will say, oh, we used to care about how our investments, what impact our investments had on people and planet, but now we don't really anymore. Let's just go back to being ignorant about it. I think once that's opened up, it'll only continue.
Mhm.
And I think that the market will respond.
Right.
And there are a lot of amazing people doing amazing work in this space. And the rate of innovation will only continue to increase. And the amount of options that you have, like there's so many a confluence of factors happening, like the improvements in technology and data collection, and all of these things will come together to allow it. I just don't know what time scale it's going to happen over. So I don't think it's going to happen over 5 years where it's going to be easy. 5 years from now, it'll be better,
Mhm.
but the new problems will emerge. 20 years from now, I think things look a lot better. If I'm having to guess at the time scale. I would love it to be a world, and I think we probably will get to a world where you're going to have a lot of reporting and data on impact, and like you could conceivably get your investment statement
Mhm.
from your provider, which doesn't just include your returns and fees, and they're bad even on the fee side. The fees are getting better and better, the disclosure,
Mhm.
and then I think there'll be disclosure. I think they'll be mandated. We're seeing in Europe right now a lot of mandate, like Europe's leading the pack, and they're mandating disclosure of some of this stuff, and that financial advisors are having to take into account the social and environmental impact stuff. So we'll see more and more of that. I mean, we can't afford not to. We're going to kill our planet if we don't. And it's just a matter of how quickly we do that and whether we do it in enough time before we, hit a point where it's, the damage we've done is irrevocable.
Yeah. Yeah, and I think maybe at this point of the conversation too, I mean, you've given so many nuggets here. I really hope that the people listening kind of identify with the value, at least that maybe I see in the stuff that you're putting out there, right? Whether it be on the social platforms or even on your newsletter. So I want to kind of at this point tell everybody that if you are wanting to, I guess, be a little bit more informed about this stuff, as well as kind of what Dave's been up to on his end, he does have a pretty cool newsletter that I'm a part, or well, that I've subscribed to as well. So I'm part of it that way. Um, so yeah, I'll attach I guess, the information in the show notes here. But before we hop off here, Dave, is there any other kind of like nuggets you want to maybe impart on us before we head out here, or?
Yeah, I mean, I would just say, like, despite the fact that sometimes it's hard to make it tangible, like here's the impact I had on this particular person or individual from my, responsible investing, it does have a big, like these things do have a big impact. So and like on the climate side alone, like your investment decisions do matter. They have an impact. It's not like you're alone as well, because this trend is continuing. So the more you talk about it, the more you do it, this stuff, like just have some confidence that is actually going to make a difference. And even though you can't necessarily, receive an award for it or get your photo in a paper, like a big check at a philanthropy gala, like it makes a difference and it has an impact. And I'd love for people to just feel good that that's making a difference. And if even if you're not an expert, like some change is better than none. So I'm just trying to provide some motivation for this stuff does have an impact. I'll share a very quick story. I was chatting with the head of a CSR department not too long ago for a large credit card provider. And she was saying, like, this team has been around for 20 years in this organization, and we've never been particularly well resourced. We don't, they just sort of have it for posterity's purposes. She said in the past 5 years, the amount of resourcing funding and how much what they're saying is actually taken into account by the management of the firm has just skyrocketed. And specifically because there are now, shareholders of their firm that engage them on these issues and are demanding to see improvement. And so they've just been, it's just been a night and day switch. So the point is, when investors speak up, these companies do pay attention and respond.
Yeah.
Use your voice.
Yeah, that's fantastic. And speaking of using your voice, I'm so glad that we were able to hear, I guess, your voice, right, and your thoughts. So I think that, at least I hope that this is well received by everybody listening, because I do think that this is very important, and I think it's also a road that seemingly is at least unavoidable in my mind in the way that things are happening in this world. So Dave, I wanted to thank you so much for giving me a little bit of your time today, and perhaps down the road I'd love to have you back here.
Yeah, I'd love to. And the last thing people can check out if they want to learn more about this stuff, check out the Kind Wealth Club. So it's just www.kindwealth.club. And that's the whole idea, is to take people on a learning journey around their ways in which they can use their wealth, whether it's to save it, spend it, or invest it in ways that make a positive impact. So
fantastic.
Thanks so much for having me. And I'd love to come on again sometime when you're ready to have me.
Yeah, not a problem. Not a problem. Like I said, much better podcaster than I am myself. So
no, yeah, this is great. This is awesome. You've got a great podcast voice.
Cool. Thanks, Dave.
Thanks, Tim.
When you hear Dave talk about this, his passion for the agenda of social impact shines through the microphone. It's the same passion that's shared by a lot of the others in the community. However, in my opinion, what makes him stand out from some of the others that I've met in the responsible investing space is his life's journey and his having lived through some of the change that he's looking to make in the world during his time in South Africa. We learn that there can be different interpretations of what responsible investing means to investors, investment funds, and its managers. We talked about how you can establish a constructive foundation for you to form more critical points of thought, and how you can impact the change that might be important to you, and how we are approaching a critical and potentially irreparable juncture where purely capitalistic decision-making has led us. Investing conscionably does not mean that prospective investment returns need to be sacrificed. In fact, there might even be ways for you to make large-scale impact by approaching human resources and asking for management of your pension dollars to carry with it a purpose as meaningful as the retirement it's funding. Of course, as Dave mentions, any action taken is better than any which is merely contemplated. With this said, I hope this helps to open your mind a little bit and embrace the change that I fully anticipate to happen in the not too distant future.